Time flies when you're having fun, and it seems that fun is turning as the bull market we've enjoyed for the past 12 months is starting to lose steam. Tech and mega caps retreated, and the dovish tone felt by Powell wasn't reverberated by the ECB and the Bank of England, as they're reluctant to join the Fed in pivoting towards rate cuts. So as the 10-year took a nosedive below the 4% handle and US retail sales barreled through expectation, the market, the data, and global policymakers are clearly more disconnected than ever. And while market disconnects provide opportunity, they also entice risk. So as Opex approaches with trillions of dollars in expiry, let's talk about risk. Risks that lie ahead tomorrow, next week, in 2024, and let's also talk about how to mitigate risk. Hello everybody, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase, and if you like this video, subscribe, hit the notification bell. We got a lot in store for you today. No 2 days in the market are the same, but what we are seeing is continued outperformance in semiconductors, particularly these smaller names. And have a look at AVGO, up 1.54%. We saw Tesla up 5%, sort of breaking out from its base. It has underperformed the broader mega caps over the last 3 weeks, and we are seeing it break out from its base. Energy, really great day. We saw this section of industrials really perform well, as well as financials, regional banks, capital markets, diversified financials really outperforming. And I think they're going to continue to outperform in 2024. But something of note, Eli Lilly down 4%, the worst day of the year. Looking at the month as a whole, we've had a great start to the December month, up 3.32% so far in December. We're on the 10th trading day, halfway through the month. Normally, the rest of the month has been higher all 5 times. This has happened back to the 1950s, up about 1.7% on average. In other words, we could see more green for the rest of 2023, despite having run so much. Let's actually have a look at the sectors as a whole. And it was interesting to see materials, energy, gold miners. These guys continue to be the performers, but they have been the laggers this year. Semiconductors really up there. Regional banks up 5%. The most hated trade of 2023 is coming back with a vengeance. I think these guys are probably up like 18% in the last 4 to 5 weeks. Insane trade from regional banks there. But we got the latest sentiment survey, and wild stuff. 51% of people are bullish, and bears are back below the 20% handle. And have a look at the historical averages, guys. Look at the 1-year bullish high, the 1-year bearish high. Normally coincides with about 50%. I would say that this is probably a good place to trim exposure because it's been a very good run, and we are seeing early signs of exhaustion. Also, the ECB and the Bank of England, they're not pivoting at the moment. They're keeping the higher for longer rhetoric, and that's why the market was trying to digest that today. But in the last 24 hours, we have seen crazy movement in rates. We saw the 10-year currently at 4.026. It was at like 3.98. It was below the 4% handle at one point, and we continue to see it's getting crushed, particularly the 2-year, and that's what you want to see. You want to see the 10-year and the 2-year move a lot lower, but the 2-year move significantly lower because you sort of want this number to be below the 10-year. If we get the 10-year below the 4% handle, that's when we'll see a lot of the money on the sidelines move into bonds, move into stocks. There is $6.1 trillion sitting in money market funds, and this is why we're seeing big trades across the board. In a lot of instruments, we're seeing huge trades come in. I mean, look at the TLT. This is some dark pool activity. This used to be the biggest trade since inception. It's now up here. Now, it could be some of these guys reducing exposure, but based on the macro environment, I would say that a lot of funds saw a retrace in rates. The 10-year went from like 3.9 to like 4.02, and they're sort of just capitalizing on that, buying the dip. A couple of videos ago, I did say once we get above this 96 handle, it probably means we go higher, towards the 100, 105 area in the TLT. Now, this is a tailwind for equities, and another tailwind we're seeing is buybacks. We're seeing huge buybacks, the biggest since 2019 as a percentage of S&P 500 market cap. And this is why we continue to see bullish flow. Along with dealer flows, we're also getting buybacks from companies, especially in the S&P 500. And on top of that, we're also seeing insider buying moving up. Normally, when insiders start to buy, it's a very, very bullish sign. And you can see an uptick in buying right here. It could be very bullish for higher price action from where we are at the moment. That is sort of the bull case I've just outlined. It's not all rainbows. We do know that Jerome Powell, the Fed, came out yesterday and they said the Federal Reserve is willing to cut rates even if the US economy doesn't dip into recession. Now, why would they say that? Quite simple. They can see stuff. They have the data that something isn't right under the hood. They're seeing worrying indicators in the data and they need to pivot. And I've been actually saying this for a while now. I've said that the Fed have over tightened, and in the coming months we will see extremely weak economic data, and this will lead to an aggressive rate cutting cycle in Q2, Q3, leading to a very mild recession or a bumpy soft landing. And I think the weakness that we're gonna see is gonna be in housing. Everything else is moderating, inflation is moderating, and we're seeing stuff like, retail sales coming in very good. Yesterday's retail sales numbers coming in much better than expected, as well as jobless claims. So I do think what the Fed are looking at, they're seeing some data in housing and they're not liking what they're seeing and they need to pivot. And that's why they need to lower rates, because a lot of people have their wealth in real estate. We're going to see how this plays out in 2024. So make sure you guys are positioned accordingly. But retail sales didn't do much to change rates. We're still expecting the first rate cut here in March. And we are expecting rate cuts all the way down to this level, 375 to 400 basis points. And we do know that at least 100 basis points worth of cuts is coming next year. The question is, do we get a recession, soft landing, or no landing? Because that determines what stocks are going to do. If we do get rate cuts and a recession does occur, we normally go ahead and have a pretty substantial drawdown, anywhere from 15 to 20%, 10 months, 12 months on. But if we do get rate cuts, no recession, multiples normally expand because companies now have access to cheaper credit, cheaper money, and they don't have to pay so much on interest. That's expansionary, and stocks normally increase, 10 months, 12 months on upward of 10%, 11%. Now, let's talk about a recession and where do you want to be positioned in that scenario? Well, I've got here 4 major recession periods: 07, 01, 2020, 1990s, and the sectors that performed the best. Now, the best performing sector is actually health, 4.29% on average in these periods. And the second best is actually consumer defensives, about -1%. But if you remove this period from health and defensives actually outperformed health. So let's dive into defensives. Let's dive into consumer staples, because we've been looking at some of the sectors in the S&P 500. We looked at energy a couple of days ago. We looked at comm services as potentially good value to put our money into 2024. So let's say you're expecting a recession and you want to buy consumer defensives before the chase. Is it cheap or is it expensive right now? On an EV to sales ratio, consumer defensive is actually quite cheap. The problem is that these companies make a ton of money in revenue, but they work on very low margins that they don't really convert it into profit for shareholders. They have a very average free cash flow yield in comparison to the rest of the market, and they don't really grow as much as other sectors. Their price to earnings growth is fairly high in comparison, and they do trade at about an 18.8 PE. That being said, they do outperform in recessions. And if you actually have a look at what names you could be buying, so this is the XLP, and you can see you could be looking at names like Costco, Pepsi, Walmart, Coca-Cola, Mondelez, Target Corporation. And what you want to do out of these is you can either just go buy the full fund if you really want to, or you could just go buy the highest quality companies, because in a market downturn, the highest quality companies are normally the safest. You could see here that, again, in the same periods as mentioned above, USA quality was the best performing in a recession. The worst performing was actually value. If a recession is to materialize in 2024, high quality consumer staple companies are going to be the best way to protect your capital while staying invested. And one of those stocks is Costco. They reported earnings today. They report an EPS beat, 358 against 343, and this was actually on weaker sales. But why the market did sort of like this earnings is because they reported a $15 special dividend every quarter. These guys, Costco, produce $56.7 billion net sales, total revenue of $57.8 billion. And this is what I say, they make a lot of money, but they don't really convert it into profit. They only made $1.6 billion worth of profit. That's a 2.8% margin. At the end of the day, you have to understand that in a recession, people are going to not buy new iPhone, but they are going to buy toothpaste. And that's why when you actually have a look at the Costco 5-year chart, you see this little blip right here. That was COVID. So in an actual recessionary downturn, companies like Costco, high quality companies like Costco, are going to be a real store of value for your dollars. And just something really interesting, regardless if we get a recession or not, this is just some data I put on Twitter. Last week, we saw 60% increase in consumer staple stocks. That surpassed their 50 DMA compared to those exceeding the 200 DMA. This happened only 5 other times, and it was the bottom in 62, 74, 87, 2000, and 2009. Regardless, staples, the XLP, could see really great growth in the next year or two, even if we don't get a recession. But keeping up with the theme of 2024 outperformance, this is small cap versus the S&P 500. One thing we're seeing is that the S&P 500 has outperformed the Russell 2000 in terms of price performance, but in terms of actual dividends, the Russell 2000 has actually increased their dividends significantly above their price, showing a disconnect between the two. What does that mean? Probably means that, smaller cap stocks are severely undervalued compared to the earnings that they're actually producing, especially these higher quality names in the Russell 2000. And this is just a tailwind for the smaller and mid-cap names to play catch up to their earnings in 2024. And every sector is actually expected to report earnings growth in 2024. Everything from healthcare all the way to real estate. And look at staples. Staples are expected to report 5.7% earnings growth in 2024. And this is how I expect 2024 to play out if these earnings materialize. We should see a sideways mega cap 7, a slightly up 493. If these 7 stocks move sideways and the multiple on forward earnings for the 493 flatlines at 15x, just on EPS growth, the index should trade 5,100. And that's my 2024 target if those earnings materialize. And here's some more data to back that up. The presidential cycle. Normally, we actually get a pretty positive year in the presidential cycle in the 4th year, which we are going into. And what we actually normally see is sort of like a flat line, and then the second half is normally bullish. Now, expanding on this chart, this right here is the S&P 500 seasonality normally, and this is the presidential cycle 4th year. We see this flat range-bound market for the first 9 months of the year, and then we get like really bullish action. In an election here with an accommodative Fed, I think what the market does is wait for earnings in this period, and then if those earnings do materialize along with easier policy, it sparks an end of year rally. But that's next year. Let's look at tomorrow. Tomorrow is Opex, and we are coming towards the end of this strength period where these dealers support price, and we are moving into the window of weakness. So Opex is tomorrow, and then we're going to have 5 trading days before we do get dealer support back in the final week of December. And this is where we could get our pullback. We've absolutely rallied and we're outpacing seasonality as a whole. Because the window of weakness is next week, this is where we could expect to see our pullback. Nothing major before we continue our run into the end of the year. Tomorrow's Opex, a lot of this gamma is expiring, but the 4,700 strike continues to be the call gamma resistance level. So after tomorrow's options expiry, we want to see where all of this gamma repositions itself. If it does go to the 4,750 level, 4,800 level, expect higher price action. If it does stay around the 4,700 area, expect continued chop around here. Now here's the gamma heat map for today, and you can see there's a huge amounts of gamma in this 4,700 area, and this will continue to support price tomorrow, probably into next week. There's so much positive gamma here. Bears really need a lot of push to get into here. Now we are moving into the window of weakness, but you have to understand that there's also a lot of gamma building in this 4740, 4730 level right here, and we want to see where all of this gets repositioned. Do they keep it at 4,700 or move up to this 4,730, 4,740 strike? Now let's hop on the chart and see what this looks like. Here's the year-to-date chart of the SPX, well above the 4,700 area. Bears are probably looking at this candle right here and they're frothing at the mouth. But what I can tell you is that we've had a fantastic run this year. Do expect a bit of a retrace, but I do think that this 4,700 area should provide huge support for equities, especially if the core resistance at 4,700 remains the same. We should see continued support even in the 460, even in the 4675 area, 4,700 area. So this area right here is where I expect price to remain for the next week or so. I think what we're going to see is probably some chop, maybe a tiny bit of a shakeout before we continue higher into year end. Before we go ahead and make new all-time highs in 2024, I am predicting that in early January, 4,800 or 4,806, something like that in the S&P 500. Looking at TLT, looking at the year-to-date in TLT, absolutely rallied. We got above this line in the sand I was talking about. Now, what I do expect is some form of a pullback into here, and before we go into higher price action and break this area right here just above 104. Small caps, another very strong day. Guys, you have to look at it. See this candle? That's bullish. Even though there was a bit of selling towards the end of the day, that's still a very bullish candle. And these are just like, we get these bullish candles, consolidation. Bullish candles, consolidation. Now we have two bullish candles. Expect some consolidation before we do go further higher. And my price target for the IWM for Russell is 212. Now looking at the equal weight, some dark pool activity, we saw huge trades come in at the end of day. And I do think that based on the macro environment, these are probably individuals, institutions adding to their positions, because I do think that the equal weight's going to outperform 2024. So I don't think these are sells in my personal opinion. It looks bearish when you look at the chart, but this looked bearish right here. This looked bearish right there. I don't think this is a bear case, especially with, the macro environment currently in. And here's some interesting data on market cap weighted indices. Now, 4 stocks account for 50% of Nasdaq gains this year, but it's actually typical in years where you've seen 10 to 25 plus performance, right? It's normally a very small amount of stocks that account for 50% of the returns. In 2023, it's 4. This has always been the case in 2014, 2012, 2010. And what we normally see the year after, right? The average beat or miss against the SPX in the year after, and again, this is average. RSP beats the S&P 500 by 4.5%, S&P 400 8.2%, and the S&P 600 11.61%. So if we don't get a recession, expect small mid caps and the equal weight to outperform S&P 500 in 2024, guys. Concentration is just a feature of strong rallies. It's not a bug, and that's why you should buy, hold, and just sit through the volatility. But we do have data tomorrow. We have PMIs, manufacturing and services. So these are going to be high impact events. It's going to be really good to see what those are. And this is the last of the major data for this week. Pretty good. We've had a crazy week, one of the craziest weeks of the year. But if you've made it up until here, guys, thank you so much. Please like this video, subscribe, hit the notification bell, and leave a comment. Cheers.